to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast and the final one for 2024. I'm Mike Gleason. Coming up, don't miss another incredible interview with Michael Pento of Pento Portfolio Strategies. Michael clues us in on why the Fed is actually cutting rates and reminds us of who they ultimately answer to. He also tells us why the counterintuitive move recently in the bond market following those Fed rate cuts should be very worrisome and maybe quite detrimental for the economy and the broader financial markets. So be sure to stick around for a conversation with our good friend Michael Pento, one of the best market analysts around, coming up after this week's market update. Gold and silver traded quietly and mostly sideways during the holiday shortened week, with all markets lacking a clear direction heading into the end of the year. That said, the stock market finally seems to be cooling off amid some weak economic numbers coming in the door. We've seen downward revisions of the government's economic data from recent months. Also, there has been unexpectedly persistent inflation numbers, increasing war drums, and some general uncertainty about what policy changes will come from the new administration. For the week, gold is down by a very slight 0.3% to come in at $2,628 an ounce. With just a few trading days left in the year, gold, while it may be off its all-time highs from a couple of months ago, is still showing a robust gain of 27% in 2024. Turning to silver, the white metal is off about 20 cents or 0.7% on the week to come in at $29.55 an ounce. Like gold, silver has pulled back over the last 8 to 10 weeks, but is still showing a yearly gain of more than $5 or 21% with just a couple of days to go before we turn the calendar to 2025. The platinum group metals have not had such a good year. Platinum is down almost 6% year to date to come in at $934, but palladium has been the big loser in 2024 among the precious metals. The industrial metal is down almost $300 an ounce or 23% since the end of last year and currently comes in at $950. After trading for a big premium to platinum for several years and even gold for a few years there, platinum and palladium essentially reached parity earlier this year. The direction of the PGMs will be one of the trends we'll be following, both on this podcast and in our news articles at moneymetals.com in 2025. Well, even as investors and institutions in Europe and the U.S. remain largely disinterested in gold, we continue to see evidence of ferocious buying coming from the East. In particular, our own Jan Nieuwenhuis published a report this week at moneymetals.com regarding some massive and secretive purchases by the Chinese. The mainstream financial press have totally overlooked what's happening, claiming Chinese gold purchases have been almost non-existent in recent months. But our research, based on import and export data, proves China has been stockpiling the yellow metal hand over fist, airlifting several dozen tons of gold out of London each and every month. To be sure, the rest of the world has increasingly been turning to gold and silver for financial insurance. We believe our fellow citizens will eventually do so as well. Be sure to check out our year-end production specials at moneymetals.com, where you'll find Walking Liberty silver rounds and 10-ounce Money Metals silver bars, both slashed to just $1.99 over spot, regardless of your order size. And there's a really interesting deal on some fractional gold coins where we've reduced premiums by as much as 52%, thanks to some big inventory surpluses we have at the moment. Well, now, without further delay, let's get right to our exclusive interview with the wonderfully insightful Michael Pento.
Greetings, I'm Mike Maharrey, a reporter and analyst here at Money Metals, and I'm here today with Michael Pento. Michael is the founder and president of Pento Portfolio Strategies. He's also the author of a book, The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market. Greetings, Michael. How are you?
Greetings to you, and Merry Christmas, Mike.
Likewise. I really appreciate you taking a little time out of your busy Christmas week to chat with me. That means a lot to me that you would take the time, so I appreciate it. So let's just dig into it here. We had a Fed meeting last week, and we had Jerome Powell and I like to call him his minions, telling us that inflation is still a problem, and yet they delivered another rate cut. Is there any way you can make sense out of what the Fed is doing and saying?
It's Christmas week, so I kind of want to try to be nice, but you started me on the wrong foot here.
Yeah.
I mean, he has his asinine 2% target for inflation. I mean, I thought the whole point of the Federal Reserve was to maintain the purchasing power of the U.S. dollar. That's ostensibly what it was supposed to be, but that's a thin straw man, a veil. Really, what their business is to protect banks. That's what they do.
Mm-hmm.
So he missed his asinine target to the north of north 2% is a target. So he was above 2% for like 43 months in a row.
Uh-huh.
And he's aggressively cutting interest rates, 50 basis points. Emergency, when he was before the election, it was, oh my gosh, we're way too tight. We got to get this Fed funds rate down, 50 basis points, 75 basis points. And now we're 100 basis points now. And we're going to probably go a little more slowly now next year. But my question is, what are they looking at?
Yeah.
The unemployment rate is very, very low, historically speaking, extremely low, way below the long-term average. We have an economy that's supposedly growing way north of trend growth. Trend growth is 2%. We're growing at like 3.3%, according to Atlanta Fed. Stock market's in a massive bubble. The real estate market is in a massive bubble. But maybe the truth is that's why he's cutting rates, because I'll tell you three reasons why. I'll give you three reasons. One, he wants to keep the bubble in equities get rolling. Two, he needs to keep the housing market from imploding. And three, he wants to help his buddy Janet Yellen, who was paying $1 trillion in interest on the debt. So it's all T-bills, pretty much. That's where the duration curve is. So it's an adjustable rate mortgage on the debt, and he needs to get that money market rate down. Fed funds competes with money market rates, and he wants to get that T-bill rate down as low as possible. And who cares if who cares if inflation is like, 4, 5, 6, because they'll lie about it. They'll just say, oh, no, it's not 9% anymore. It's 2%. Or actually, it's the core rate. So, has a 3 handle.
Yeah.
He'll just say, oh, it's way down from where it was. So let's declare victory. Aren't we a great institution?
Yeah. And then they'll blame somebody else. I was mentioning this to somebody the other day. If you listen to what he says, they're always taking credit for, hey, we've done really great work. You're getting this price inflation. Never once have they ever said, we might have caused this to begin with. It's always Putin or, greedy corporations.
Right. It wasn't the fact that let me see. So it wasn't the fact that you printed $5 trillion
right
after COVID broke out. That wasn't the issue.
No.
That wasn't it. We don't really care that we bankrupted most of the middle class of this nation. I mean, they can't afford to eat properly anymore. They can't afford basic, healthcare, insurance, taxes. But we're so happy now that we're close to 2%.
Mm-hmm. Yeah, it's crazy.
And they don't care that the dollar's lost like 98% of its purchasing power since 1913.
Right.
None of those things matter.
No. Well, let's talk a little bit about the interest on the debt, because I think you hit on something that's really important. We've got, and it's not just the federal government, but we'll kind of stick with that because it's kind of the almost the microcosm of what's going on. But we've got massive corporate debt. We've got massive household debt. And I say all the time, this economy is built on easy money. It can't survive in even a moderately tight interest rate environment. And yet, over the last couple of months, since they started this rate cutting, we've actually seen yields on the higher end of the bond curve going up. And, that's a little bit counterintuitive. You think, well, they're cutting interest rates. Maybe we should be seeing interest rates coming down. Can you kind of explain why we're seeing this little bit of a dichotomy going on?
Yeah, we're an insolvent nation. We have not conquered our problem with inflation at all. The Fed is throwing gasoline on that inflation problem. And we have a massive amount of illiquidity now in the bond market. The reverse repo facility, which is where most of those excess reserves, credit was created, since the GFC and it's more particularly after the COVID crisis.
Right.
There was $2.5 trillion of excess reserves parked at the Fed. That number is now 80 billion.
Oh, wow. Yeah.
That's a big amount of QE that was running along concurrently with the QT program of the Federal Reserve. So I'm not surprised that illiquidity is rising. I'm not surprised that bond yields are rising on the long end. What I found very interesting, Mike, is that when the Fed, they cut interest rates by 25 basis points, but they lowered the dot plot by 50 basis points. They were supposed to cut by 100 basis points or 1% in 2025.
Right.
So in other words, this was a very hawkish move. They said they were only going to cut 2 times or 50 basis points in 2025. So if you're more hawkish, that should have sent people scurrying into the long end of the bond market, right? You're more hawkish, which means growth is going to be slower, which means inflation is going to be under control more, to a greater degree. And that should have sent bond prices higher and yields lower. But the exact opposite happened all the way out along the yield curve, even 30 years out. The 30-year dropped by, the yield went up by 10 basis points. So that is indicative to me that's saying, hey, look, the bond market is illiquid, the country is insolvent, and we have big problems coming up in the bond market. And I think we're just beginning to see them. Because I'm thinking to myself, what happens if we do have another crisis? We do have a recession. Not if, when
Right.
we have a recession. By the way, the last recession occurred. So we had an inverted yield curve. The yield curve started to normalize, and 6 months later, we had a recession in December of 2007. Well, you know what? The yield curve began to re-invert or normalize or steepen just a few months ago.
Yeah.
So it wouldn't surprise me at all if we had another recession starting around March, when the Treasury General account is probably going to be tapped dry. And then there's no liquidity. The market is going to run into a liquidity crisis. No reverse repo facility and no TGA. And then I would assume the Federal Reserve will stop QT by that point. But you're going to could have a big problem in the bond market, because as foreigners don't really want to hold our dollars and our debt anymore. And if the Fed's not buying that, who's going to buy it? You know what, Mike? In the next recession, the annual deficit, so the deficit in 1 year, could be $6 trillion, just based on what the percentage of the increase in the debt was in the last last 3 recessions.
Yeah, we're running over $1 trillion with this supposedly great economy. So,
well, the deficit's $2 trillion.
Right.
The interest on the debt is $1 trillion.
Right.
So we could have, a 300% increase, because the automatic stabilizers kick in. There's nothing Congress doesn't do anything. Just the unemployment insurance is automatic. They don't have to pass any kind of like TARP or TALF or any of those other crazy things I'm sure they'll do. And then the revenue dries up. So you could have a $6 trillion deficit. And I think the bond market's saying, who the heck's going to buy it all?
Yeah.
And if the Fed does buy it, if the Fed does buy it all, and inflation goes back to 9 or 20% where it really was, how much long-term U.S. debt are you interested in? And then you could say, well, Mr. Pento, maybe the Fed will just buy everything like they do in Japan. Are they going to buy municipal bond debt? Are they going to buy corporate bond debt? Are they going to buy mortgage-backed securities? I mean, how much fixed income do you think the Treasury is going to buy? And if they do assent to buying everything that's not nailed down, and inflation goes through to the moon, and there's helicopter money, what do you think your portfolio is going to? I mean, in real terms, what do you think your portfolio is going to do? So you can't just say, well, I'm going to be a 60-40 investor because the Fed's going to buy everything, and we're going to have hyperinflation, and the bond and the stock market usually goes up in hyperinflation. Well, that's true, but what part of the stock market do you want to own?
Right.
Do you want to own fixed income and like utilities? Is that what you want to own, and bond proxies, or do you want to buy base metals and energy and stuff that actually goes up the most here? The whole concept of investing is you have to make a real return after inflation. Right. That's it.
Well, speaking of real returns, given what we're kind of seeing in the bond market, and given the debt levels, given the fact that we have $1 trillion interest payment every single year, do you think that the Fed is going to end up having to keep that lower end below the real interest rate? In other words, where we have negative yields, and in fact, do you think that's the scenario?
Well, I would hate to agree with you, but I think I'm forced to agree with you. But here's the thing. So we normally, before 2007, actually before 2000, most of the lifetime of the Fed since 1913, we've had a real interest rate. So the Fed funds rate minus inflation was positive. But that all changed, especially post the GFC. We had 10 of the last 14 years where real interest rates were negative and sometimes like 8% negative. And what that means is so important. So in other words, if I am an investor, if I'm a saver, I have money to invest, and I say, I'm going to buy like a bond or something like that. I'm going to put my money in the bank. I'm guaranteed to lose money in real terms. That's what negative real interest rates do. Right. And savvy investors know that. And they say, well, if the Fed funds rate is 1 and inflation's 9, I'm losing 8% per year in real terms. I am going to do something else than keep my money in the bond market. I am going to buy stocks and I'm going to buy real estate. That's exactly what happened. To the point where, like Blackstone was buying, single family homes as much as they could. Yeah. And, 25% of even more. In some cases, there was 60% of all single family homes for that particular month were bought by investors. Yeah. I remember. So you have crazy things like that happening, and that has distorted prices incredibly. And I'm hoping, and I think I'm correct, that Powell and his merry band, let me say this correctly. Powell and his merry band of money printers are going to be reticent and reluctant to go back to ZIRP and QE. And Yellen will be very reluctant to go back to QE right away because they know where they know where helicopter money. They know where helicopter money and QE and ZIRP end up. They end up bankrupting the middle class of this country. Right. And they end up causing 20% inflation at a minimum. So they're not going to we have GDP is now growing at 1% or close to 0%. So we're not going to go automatically back to zero. No, it's not going to be as fast as it was before. So Powell will be a little bit late to the game before he slashes interest rates. But it will happen. Right. I have no doubt about it. And I have no doubt there's going to be QE and ZIRP and helicopter money. Yeah. But it's going to be after the market's down 30, 40, 50%. Wow. Yeah. And then here's the question. Here's the big question, Mike. What happens to the long end of the bond market? Because every other time since 1981 that the Fed has intervened in the stock market to keep asset prices higher and real estate from collapsing, the long end of the bond market behaved because the problem wasn't we have a problem with inflation. The problem was since 1981 we have disinflation or deflation. That's how they think. Yeah. But now we know record high inflation is salient in the minds of Americans. And I think, and my opinion, which is, and I think is a fact, inflation is the market's belief in the purchasing power of your dollar. That's what inflation is caused from. If I print a bunch of high-powered money and the Fed's balance sheet goes up, that's not exactly dollar for dollar how inflation happens. Okay, it's too much money chasing too few goods. And if you have a habit of printing too much money, you destroy the confidence in the purchasing power of a fiat currency. And that's exactly what's already happened. And they're going to make it a lot worse the next time around. Yeah. So what does the bond market do? If the bond market doesn't behave like it normally does, which is prices up and yields down, the long end, and its prices down, yields higher, then we're going to be in a huge problem in this country. Because, where are asset prices going when let's just do a thought experiment. What's going to happen to the real estate market if mortgages go to double digits? Well, given where prices are and given what I just said, where mortgages are going, the real estate market's going to plunge. And I don't care what the Fed is going to do. Right. Yeah. I mean, at some point, they lose control of the markets. So it's just, I think a lot of times people and even the Fed people themselves, there's a little bit of hubris there. I think they overestimate their ability to keep things under control. They're demigods. Yeah. Every word out of their mouth is parsed like we're reading scripture.
That's a great way
he
to
took
put
one
it.
word. He took this word out of his statement. What is
Yes,
he
I
going to
know.
do?
I love it when you get it on the CNBC always does it. They give you the two statements and the red lines and the
Yeah, exactly.
yeah.
And here's the thing, Mike. In a free market economy, which we don't have anymore, I mean, of a free market, the most important price signal there can be is the cost of money.
Of money, yeah.
And why we've relegated it, we've usurped it from markets and given it to, 12 voting members on the Federal Open Market, the 12 apostles of the Federal Open Market Committee.
Yeah.
Why do we do that? I mean, can't we just say, here's a simple solution. GDP growth is, trend GDP growth is 2% because that's population growth plus productivity. And we'll just expand the Fed's balance sheet by 2%, no more or no less per annum. And we kind of, regulate the banks so that, if a bank goes under, if they expand the money through fractional reserve system, they go crazy, you got a business. Yeah. They're done. And then you have markets. So it's the demand for money versus supply of savings will set the cost of interest rate.
Because you and I both know.
And if banks know they're going to go under, and then they'll take less risk.
Yeah, absolutely.
They know there won't be a bailout right around the corner.
Of course, the problem, and you and I both know this, is the fact that without the persistent money creation and the persistent tinkering with the bond market, the federal government can't keep borrowing and spending to the extent that it does.
Yeah.
And
exactly. Right.
With that, let me we'll close out on this thought. We just had, I call it a fake debt ceiling fight because raise it at some point. It's posturing, a kabuki theater for the most part, but. It does kind of underscore, at least makes people think about the fact that the borrowing and spending is out of control. We have got Trump coming in. He's talking about cutting government. We've got Dodge. We've got Elon Musk. Do you have any confidence that the new administration can actually get even a little bit of the spending under control, or is it just going to end up being business as usual in your mind?
But, first of all, it's a great interview, and you're a great questioner. I mean, the last question you asked me, I could talk about for like an hour.
Yeah.
So, the two things, at least two things I'm going to try to get out in time is, number one, the Department of Government Efficiency, DOGE. I find very ironic that the Department of Government Efficiency was strongly advocating that we raise the debt ceiling. In fact, abolish it completely. Yeah. So you had Trump, and I voted for Trump. So this is not an anti-Trump comment. I'm just saying Trump and Ramaswamy and Musk were arguing to get rid of the debt ceiling completely. But you're heading the Department of Government Efficiency. Why is that a little counterintuitive, at least? And I think, when it comes to spending, you have defense, you've got interest, you got Social Security, Medicare, Medicaid. Those are mandatory things that, no one's going to touch. No one's going to touch that. So you can tinker around the edges and say, we'll cut a few billion here and a few billion there. But the dramatic changes to the budget are not going to happen.
Yeah.
But I will say this. I thought it was interesting that the debt ceiling was okay. So they did this continuing resolution, the stopgap spending measure, which 3 months. They punted the ball for 3 months, stuck their head in the sand for 3 more months. Yeah. But they did not raise the debt ceiling, not by a penny. 38 Republicans in the House, the Freedom Caucus, said no, we're not doing that. So I don't know if they did it. Here's the question, and I don't have the answer yet, but we will in early 25, in March 25. Are they just doing that? Are they doing that just to posture because the blame goes on Biden if something bad happens right now because he's still the president?
Right.
Or will they all fall in line under Trump? I don't have an answer for you.
Yeah, it'll be interesting to see how it plays out.
But it'll be interesting because if you do things through continuing resolutions, with the Byrd Amendment, you have to pay for it. So, I mean, Trump might be able to extend the tax cuts later in 25. That's not a tax cut. He's just extending the taxes as they are. So it's not really on a rate of change basis. It's nothing. But he might have to pay for that.
Yeah.
Right. I mean, the DOJ, I think they wanted a $5 trillion increase in the debt ceiling. They didn't get it.
Right.
But if they're going to get that kind of an increase, they might have to have massive tariffs in place. Yeah. So, I mean, I just don't think it's very superficial to say, Trump won the election. We're going to have massive tax cuts, even above and beyond in the extension of the Trump cuts. And we're going to have massive deregulation. I would hope that he can cut taxes, but I would also hope that he can cut spending dramatically too. I just don't see that. I just don't see that happening.
Yeah, I'm the same. I want to be optimistic, and yet I've been watching this for a long time. And, I thought it was notable. You've got all of this talk about kind of budgetary hawkishness. And yet, even with this continuing resolution, they added another $100+ billion in spending. They did the disaster relief. They put in the farmers aid. I think they put in money for the bridge. And you could say, yeah, these are important things, but it seems like they always find something else to spend money on. So I'm not very optimistic. So, before we go, go ahead.
I'd be happy if you want to do away with the debt ceiling, at the very minimum, and this is the bare minimum, you have to say, okay, we're going to replace it with a debt to GDP cap. That would, I mean, I can say, okay, we want debt to GDP has to be under 90%.
Right.
And then if it's above that, the government shuts down. So, I mean, that would be something that you can say, okay, well, the debt ceiling has to be voted on, but listen, you need to have a debt to GDP ratio that encourages growth and stability in our bond market and stability in our currency. I I haven't heard anybody say that. I only heard, let's just suspend the debt ceiling. Yeah. It's something that we don't. Well, it's been around since World War I, and it sort of says, hey, this is the most debt the United States is willing to incur, and if you can't replace it with something that is meaningful, like the debt to GDP ratio, then I say keep it. Keep these guys in line.
Right. I mean, at least it gives the illusion of some accountability anyway.
Right.
And so
hey, who cares about debt? Listen, Mike, who really cares about debt when you can just print money?
Well, I wish I could print money. Oh, well, I'm a peon. Well, before we go, I want you to let folks know where they can find you and your work, your book, all of those things. Where do they go find Michael Pento?
I wrote a book in 2013 called The Coming Bond Market Collapse. And I said eventually we're going to have a huge problem with inflation, and that's going to bring the yields in the bond market much, much higher. We're seeing that happening today. It wasn't a prediction that was going to happen in 2013. I said eventually, if we keep this kind of behavior up, where the debt to GDP ratio skyrockets, there's no limit to the debt, and there's no limit to the Fed's balance sheet, we're going to have a huge problem in our bond market, sovereign bond market, and it's happening today. Yep. But if you want to reach out to me, it's the website is pentoport.com, and on it you'll see the midweek reality check, which I publish for $50 a year. If you like it, there's a 5-week free trial. You can, kick the tires before you spend that $50, and you'll get the real insight, the real data, and the real insight, independent of the madness that's on Wall Street and DC. And there's a lot out there. Yeah. And if you have $100,000 to invest, and you're a U.S. citizen, and you qualify for the portfolio, then I will manage your money myself in the inflation-deflation economic cycle portfolio that I've created.
Outstanding. Well, folks need to find Michael Pento's stuff, because I think what we're hearing in the mainstream is not going to play out well. So, well, again, I really do appreciate you taking the time. I know it's a busy week, and I hope you have a very, very Merry Christmas, a Happy New Year, and thank you.
Thank you. God bless. Take care.
Wonderful to hear from Michael Pento again, and I hope you enjoyed that interview. And that will do it for this week, and that will do it for this year in terms of our weekly podcast. We very much appreciate the legions of followers who tune into our programs each week, and want to thank you for allowing us to play a small role in your financial lives. We hope you find the information we put out each week to be helpful. Be sure to check back next Friday for our first weekly Market Wrap podcast of 2025. To check out any of our audio programs, just visit moneymetals.com/podcast or find those on whatever podcast platform you prefer. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening. Have a wonderful weekend and Happy New Year, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.